Good morning, everyone. Thank you for joining our Nedgroup Investments GEM Fund update. During these difficult times, we want to support and equip you to proactively manage your clients' concerns. This telecon will be recorded and the replay will be made available thereafter. The session is also eligible for CPD points. The Nedgroup Investments GEM Fund is a portfolio of 75 to 90 stocks, carefully selected and diversified by region, country, and industry. The fund aims to produce long-term growth while preserving capital better than the market during difficult conditions. Rigorous country and liquidity analysis is a critical value add due to volatile countries, currencies, politics, and governance. Anil's Partners as a business is owner-managed, with the core team having worked together for more than 20 years. Our topics for today include the market context, fund performance, and fund positioning. Good morning, Ian, and thanks very much for joining us. Ian, can you hear me?
Yes, I can hear you, Anil.
Okay,
can you hear me?
I can hear you now. Good morning, and thanks very much for joining us. Let's kick off. How are you feeling?
Yeah, thank you for the invite.
Okay, yes, wonderful. So, Ian, you've been involved with managing various emerging market mandates for, let's say more than a quarter of a century, actually. Have you seen anything like the current market conditions? And, maybe what are some of the similarities to some of the previous, market events that you've experienced?
Yeah, thanks, Anil. Thank you for rounding down slightly my experience, shall we say, there as well. Yes, I've seen plenty of, we call them market dislocations, as well as the booms. I've seen plenty of busts and shocks, devaluations, and even coups. Starting probably 87 early on, but then also Asian crisis in 97, and obviously the GFC more recently. And there are many similarities, but also some crucial differences. So I think it's important in major events like this and major shocks to know the principles that are at work. Although, of course, the experience, which gives you good reflexes, I think, and good common sense checks, are also very helpful. So I think that let's do the differences first. We are seeing a massive supply side shock. We are now seeing a massive demand side shock. And on top of that, we've got a huge oil glut that was also a bit of a shock, with the deflationary consequences that go with that and the impacts on credit, because there's $1 trillion of lending to the oil industry. All of this has happened incredibly rapidly, which is, again, more unusual than it is common. So, according to our analysis, the global output fall will be at least as great as we saw in the GFC, could easily be more, but more importantly, is faster and has been global very rapidly. So we are already seeing the start of an unemployment surge, and we will expect this to continue. But we do hope that this will be transitory because of the nature of the virus and the fact that some demand hasn't been destroyed, but has only been delayed. Although, of course, many of the service sector demand will be destroyed. There's only so many times we will go back to a restaurant when this is all over. Only so many meals that we can eat. But for many demands, it will just be pent up and will come back more rapidly. As inventories are built up, they will then be wound down. So the demand shock and the supply shock and an oil glut is the unusual trifecta we have here. Now, the policymakers, though, have been very swift to act, much more rapidly than before. So we also see the policy response being larger than in the GFC. So although rate cuts are smaller, we are seeing more QE and more liquidity support, and it has been more rapid. They've got the toolkit. They don't have to argue and debate and send policy papers. They are ready to go. They're comfortable with their reflexes, their institutional reflexes. What is new this time is that we're seeing banks being incentivized and already in some cases compelled to lend. We expect we'll see more of this going forward. And then, of course, we're seeing a big fiscal easing, whereas in the GFC we often saw fiscal contraction. They all talk of austerity. So now we're seeing a big fiscal easing, and again, we expect to see more. So this policy response is also unprecedented in sheer scale and in speed. And I might come on to this a bit more later on in this discussion. But we're already seeing US money base exploding to the upside. And this should head off the US dollar shortage that was an indicator of and a cause of many of the problems in markets that we saw a couple of weeks ago. We know that at that time when people are unwinding positions and you think, well, these indicators or these stocks or these commodities are usually inversely correlated, and suddenly they're all correlated. That is when you have a dollar shortage and people with leverage positions are having to liquidate. So that's when you get gold going in the opposite direction, going in the same direction rather as some other risk-on assets, because the owners of those are selling what they can rather than what they want to. And you can see from the markets at the moment we're starting to see a bit less of that. And sure enough, the dollar and that's an indication that the liquidity action from the authorities is already starting to work, I think.
And Ian, okay, sorry, go ahead.
Oh, I was just going to then go back to the fundamental cause of this, of course, which was this disease. So we've already seen new cases look like they peaked in Italy. And I think that Western Europe is starting to peak about now, and obviously each country is slightly different, and there are different ways of measuring and so on. But if we assume that they're all broadly the same, which I don't think is too extreme an assumption, actually, having looked into it in some detail, they're probably peaking around now. Now, obviously, we have to assume that as restrictions are relaxed later in China and other countries in East Asia, we don't get a significant secondary surge, which is what we're all looking for, we're all checking about. But if we're getting cases peaking about now, the rest of the world may only be a week or two behind, and markets will probably look through more than we think, than people would naturally assume. So there's quite a few things in place now already that would get us to be moving. We're going through the usual cycle of denial and then capitulation and then despair that you get in a bear market. We're moving through all these as well incredibly rapidly. Sorry, Anil.
And Ian, yeah, sure, great, thank you. And just something you touched on about the global oil market dynamics. I mean, it's been especially peculiar this time around. Do you mind elaborating a bit more for us, please?
Yes, of course. Well, it's one of those ones where, with hindsight, you can see the issues building up for quite some time, but it took a major catalyst, such as the demand shock from China initially, to have triggered the big fight, I suppose you could call it. I think Russia and Saudi Arabia have been building up to this for some time, and in a way that makes the price action worse, but also shows that those two combatants have actually been prepared for it. So, apologies to anybody who's already very well aware of this, but cartels for a start, the OPEC cartels in general do not often thrive in a deflationary or disinflationary environment. Add to that the technology change that has occurred in the oil industry, and this is a cartel that for many years has been struggling to keep it together. And I think Saudi Arabia and Russia both realised, in Saudi Arabia's case, very belatedly, that it wasn't in their interests. Saudi Arabia tries to keep the oil price high by producing less, and everybody else in the OPEC cartel seems to cheat. Russia quite openly, but then they were never really in OPEC properly. Obviously, they were OPEC plus. This keeping the oil price high and ceding market share to everybody else obviously was a huge boom to the US shale manufacturers and everybody else with a higher cost base who took market share. But obviously shale then used that to utilize the new technology in the drilling and fracking and really changed the world, basically. And the US obviously now being an oil exporter rather than an oil importer, which obviously has huge implications for geopolitics in the Middle East as well.
Yeah.
So this all came to a head. Russia weren't willing to keep playing this losing game. I actually don't think it was in Saudi Arabia's interest and hasn't been for many, many years. Only in their short-term interests, no interests. I mean, you can imagine Samsung trying to keep the price of semiconductors high. It would just be, it would be allowing the Chinese and Micron and so on and the less efficient competitors to gain a foothold. So I think they've belatedly realised this and then basically abandoned the price mechanism and flooded the market with oil. And I use that word advisedly because they haven't just been abandoning their quotas and trying to keep the price high and allowing the price to settle down. They have actually offered huge discounts. So up until recently, the price you're seeing on your screens for the price of oil is not the price people are transacting at. They are actually buying oil less than that at a significant discount from Saudi Arabia directly. So again, huge history-making moments occurring partly, the catalyst, but not the cause, was the virus, the coronavirus. But that was just the last straw, I think.
Yeah.
On the crumbling.
Yeah. And Ian, that's all amazing stuff, which I think a lot of people definitely didn't know about. Turning to the Nedgroup fund's performance specifically now. So, since inception last year, you've outperformed the Morningstar GEM peer group and the MSCI EM index by about 5% each. Can you please share what some of the key drivers were, and also if you can please touch on Q1, because that's been particularly of interest now. Just on the attribution numbers, perhaps your top 3, bottom 3 stocks, and so on.
Yeah. Okay. So first thing I would say is that we normally pride ourselves on a bit of downside protection. So for us, we think we should have done better in this market. So we're certainly not sitting back thinking, oh good, we've lost less money than the market, and we're striving to do better all the time. But we have had some reasonable stock selection, as well as a few things go less well, and some of the country selections done quite well. So I suppose the key areas that have led to the outperformance in this bear market has been stock selection, good old-fashioned stock selection in China and Korea in particular. We've had some great stock performance in China in really high quality, high profitability software and internet names. I'm thinking security software such as Venus Tech and Yonyao network technology software and cloud plays. We're really trying to push this enterprise software and cloud software, which of course is getting a boost from work from home now as well. And I've actually added to those names but taken profit in others. The Chinese banks have done well, which was both a positive because we own China Merchants Bank, the private sector bank, the more entrepreneurial one, but so have the big state-owned banks, and we don't own those, and we're not really in the mood to buy them now either. And then the other name that's done well is a very high-quality cement name, believe it or not, very high returns on capital. They've got a little monopoly going on in their region. And as everybody expects a stimulus from the Chinese government, I think people have looked around and found a name that will be around making good levels of profitability when that comes, because nobody's in the mood to buy something that has a stretched balance sheet. And this one's very high quality, and that's what used to be called Anhui and now just called Conch Cement. It's been in the portfolio a long time and is really doing its stuff. but also had good stock selection in Korea, with timely purchases of some China-exposed names after China had the virus, the worst effects of the virus, and also some semiconductor names. Also, our gaming stock, CD Projekt, has done quite well in Poland. Again, another long-term winner for us. And also on top of that, we've been underweight some of the worst-performing countries. Obviously, we haven't had Argentina earlier last year, and we haven't had Turkey for a few years until recently, and we've been underweight Brazil significantly recently, and I'm afraid to say South Africa obviously has been an extreme underweight for us. And we've had a little bit of cash because we were expecting some opportunities to arise. So all of that has generally been more positives than negatives. I will name the negatives out there because we like to be very open and transparent about these things. And of course, we got caught with some exposure in the leisure and tourism areas. Long term, we think they are fantastic, positive stories, structural investment opportunities in Asia in particular. But at the moment, you can imagine it's not the time to be in the hotel industry or the restaurant industry. So the names Lemon Tree and Minor have been negative contributors to us.
And Ian, you mentioned about your underweight to South Africa. Obviously, we've got a lot of South Africans on the call, and of particular interest to our South African clients is that you've also outperformed the All-Share Index by, it's almost 13% since inception. So what would you say are the key benefits for a South African investor in having GEM exposure?
Okay, well, there's three, I suppose. There's the good old-fashioned, which I'll tick off the list first, diversification, a broader opportunity set, and better diversification for having anything, any investments outside your own domestic market. Secondly, I think that South Africa, although we're not the biggest bears out there by any stretch of the imagination, obviously has significant structural challenges, both as an economy and also on what we call our long-term institutional rankings. South Africa has quite a reasonable institutional quality ranking on our scores, but unfortunately most emerging markets are improving and South Africa's hasn't been. And we find that's a very important long-term driver of returns. And then thirdly, we've just got some very, very exciting opportunities elsewhere. In the past few years, it has obviously been very exciting to get exposure to the new economy, new technologies, new business models that you can find in Taiwan, Korea, India for its consumer names, and China, of course, has both that and a huge consumer market that is rapidly becoming middle class. And we find that's a very exciting and very profitable area to go finding stocks in as the middle class emerges, and as you measure the number of people who can afford your product at a certain level, that can increase by, say, 100 million people in quite a short period of time. So if you find a good company addressing that kind of market that's growing that quickly, just through the wealth effect, not through GDP growth, then we find that's a good risk-reward place to put your money. And we've done very well with names like that. And in fact, that's one of the things we've done lately. So in the last few years, we've done very well out of a company called Li Ning, which makes sportswear, the Chinese-only brand. And we took profit in them around the turn of the year, and had them for a good few years. It's been an incredibly profitable investment for us. It's like the Adidas or Nike of China. And it has a brand awareness of only slightly below Adidas, or around the same as Adidas in some towns, and below Nike, but above all the other local brands. And we've just gone back, we've just started investing in it again, because of course now we're getting the reports from both Li Ning and Nike and Adidas that China is opening up and getting back to normal, and people are going out and buying their sportswear again. You often get a bit of a health kick after these episodes, by the way. We did with SARS in a way. And Nike and Adidas are reporting that China is now open for business, but actually they're closed or closing in the US and in Western Europe and everywhere else in the world. So Li Ning, you're getting that exposure directly, and you're not getting the exposure to the rest of the world. So there's a sort of an element there of China being first out, first in, first out.
Yeah, Ian, I mean, some of your stocks have definitely been some of the most interesting companies I've ever seen in a portfolio. I want to get into a bit more detail on that a bit later, but for now, maybe just a few philosophical questions, like your quality growth style and where you focus your stock selection on companies that outperform their cost of capital. Can you please tell us a bit more about that?
Yeah, there's a couple of fundamental points there, I think. A lot of this is getting the right amount of capital in the right stock, in the right country, and at the right time. But there's certain things you can do to make sure that the, the probability is on your side. So you're only picking amongst the best ideas and not trying to be really clever and find a company that isn't very good that will suddenly turn around. If you find a company that has a business model that is working, a business model that is creating shareholder value, then if you get your other pieces of analysis right and you try and improve your timing, you should make lots of money. So, for instance, if we see a boom in, let's say, consumer going forward, to go back to the Li-Ning example, we know that Li-Ning will make money if that happens because they have a good business model, they have a good product, they have a strong franchise, they have a competitive advantage, and that competitive advantage in their product or service will mean that they will generate shareholder returns. They will generate true economic, not just accounting, profits. You get that right at the same time as these other structural or cyclical or macro trends, then you know you've got the right stocks that will make money for you. The problem with not having a quality approach, trying to find companies that are just cheap, is that in emerging markets, you can wait a very long time before management come along and make returns for you. It's not the US, where if management are not very good, or if those assets are not earning a significant return, the market or the institutions will deal with it for the shareholders. Management will be removed, or the company will get taken over, or those assets will be sold. The market and institutions together will make sure that capital is earning a return where it can. In emerging markets, you can wait a very long time sometimes for the management to change, or for the market to solve it for you, or for the institutions to affect change. So all those things are not on your side. So I think that traditional approach of value investing, say, might be a bit harder in emerging markets philosophically than it would be in many other countries where the time waiting for it, you don't have to wait for so long. But also there's so much structural change going on in emerging markets. I think you get paid also a bit better to find companies that will take advantage of that structural change and make money out of it, and that they're working for us as minority shareholders, not for some other convoluted corporate governance structure.
Mm. And Ian, I mean, in your answer now, you've really, contrasted a lot between, let's say emerging markets in the US and, various countries and so on. Now, I know that you do a lot of country and liquidity analysis, and that's actually quite unique amongst your global peer group. So what's the value in spending so much time on this stuff? Why not just do pure bottom-up stock selection?
Yeah. Well, again, I think if I was just investing in developed markets, this is a much more nuanced discussion. But I think in emerging markets, even ignoring this current volatility we've got now, and I'll come back to it in a minute, but just saying we're in a steady state as we were up until a month or three ago, then there is not much point in having the best stock in a challenged country when it's an emerging market. Because let's just say you get on that side, you get the best stock in Argentina. Well, that hasn't done you any favors, as Argentina has seen the risk premium shoot up, the currency devalue, and the country get into a vicious circle. You could have the best stock in Turkey over the last 4 years, and it hasn't helped. It's just destroyed less value than having the average stock in Turkey. So you're better off not having any capital in Turkey or Argentina when their countries go through these issues. Come back and then look and see if there's real structural change and then buy them.
Yeah. And Ian, I mean, okay, go ahead.
Well, I was going to say, and of course, I think now we're going to get one of those episodes that are really magnified. So if we, I really am pleased that I have this monetary policy liquidity toolkit to look at now in this very unusual market environment. So we are seeing liquidity move around very rapidly globally. We're going from a period where there was no liquidity a few weeks ago to a period where I suspect going forward we're going to have abundant liquidity. And now, for me, I am very pleased as a fund manager picking stocks that I have that toolkit to know what market environment I need to have the portfolio for, because it is now about to change incredibly rapidly.
Yes, and Ian, I mean, you've really been speaking a lot about risk management, and for an EM mandate in particular, that's quite critical, and even more so at times like these. Do you mind just jumping into that a bit, please?
I'm sorry, Anil, could you say that one more time, just that last bit?
So I'm saying in your last answer, you were speaking quite a lot about your risk management. I just wouldn't mind because, especially for an EM mandate, it's quite critical to have very good risk management, and especially at times like this. So can you please just speak a bit more about that?
Yes, no, it's very, very important, and sometimes we sort of, as fund managers, don't talk about it as much because we just take it as a given and assume. It's very important to deliver on what your analysis has put. So if you assume you get, let's be generous to me and my team, assume we have a 60% hit rate on our analysis, the last thing you want is to still lose money on that 60% hit rate because you've got your capital allocation wrong, your risk model was wrong, or you've not kept the capital tight enough on the other side. So we have a constant, not only do we have all the risk models live, and we can actually say what if, so we can put in, okay, we're going to make this change to the portfolio. What does it do to the risk that we're taking in advance of taking the position, obviously all running live, as well as that. And we have an external risk committee and so on, so it's not just fund managers looking at it. But as well as that, we also have a really robust peer review mechanism, because most risk models are backward looking, really, or they're using historic data to assume things about the future. And that is not good enough in itself either, especially when you have these periods of high volatility. So it is important that a manager knows the risks of both the country, of their own forecasts, that they have conviction in them, and they know the individual stocks, because that is where you're either going to make or lose money. And it's how this all fits together is crucial. So yes, we have our risk models, which I'm sure everybody else does as well, but it's also how we then integrate those into the portfolio in everyday decisions. And that's where we get into this loop and peer review and peer challenge. So everybody in my team is challenging one another. Do we have the right amount of capital in this? Are we taking the right amount of risk? And it's very important to us not just to have the diversification, but to sweat our capital very hard. That means we can make higher returns for less risk. Now, sometimes people think they've diversified it all away, when in fact all they have is they've got large pools of capital not working at all for them, which when they want to make a return, because we're all in a competitive environment, they end up taking unnecessary risks somewhere else. And that's, I think, what we seek not to do as well. We seek to work the capital very hard where we have the conviction and not where we don't have the conviction. So it all ties in back into the forecast, into the portfolio construction, into the stock picking, and into the macro, and all our own work, and knowing what our conviction is in every forecast and every position.
Okay, Ian, I mean, we are running out of time, so I just want to ask you a bit of a complex question. So where there's been quite a lot of indiscriminate selling in the markets, but potentially leading to many attractive opportunities presenting themselves. So I wanted to ask, so what actions have you taken during Q1? And particularly where you've already got quite a sizable weighting to China and there's really a lot going on, there's like massive dynamics at play. Can you just please share some of your thoughts on all of that?
Yeah, so there's quite a few things going on, obviously. It's been quite fairly busy. The first thing, first, we went into this with a little bit more cash than normal. So obviously it's a good opportunity to put that cash to work as the markets fall. There are a few old favourite stocks that we think are incredibly high quality and which are businesses and franchises that we either own but want more of, or that we don't own but wished we did. This is obviously an opportunity to pick some of those up, especially when there was forced selling early in this bear market. I think we're beginning to come out of that process now. There may be some more final capitulation, but I'm unwilling to count on that. I think there was such a liquidity shock early, as you saw with the dollar surging, that we might be passing through that period now. It doesn't mean we're quite at the bottom, but we may find that was the bottom mark, even if we go back and test it again. So we've been picking things up that we, these franchises, these very strong, high-quality stocks that we really like. Very, very hard to think that in 2 years' time you don't want still very high weightings in Taiwan Semiconductor and Alibaba and Samsung and these global winners. But we've also looked at a few names. I mentioned Li Ning earlier, that we'd sold, and now we get the opportunity to buy it back much cheaper again. And this is a business that we're turning around ahead of other businesses because it's only China, not global. So if that idea of China being first in and first out in this holds, then that should be good. And there's plenty of other companies out there. There's new ideas as well that we put on the portfolio. We think that the world is going to be very different in the next 10 years. I think we could be changing leadership. We've been positive in the long run, but less aggressive in the short run on emerging markets. That could be changing for us. We could be getting a lot more optimistic in emerging markets relative to the rest of the world. And that actually also leads to be more optimistic on different companies and different business models within our space. Now, I think we've got a while for that to play out within the stocks, but this is going to be a very different environment in the next 10 years to the last 10 years. Our banks being compelled to lend. If we see broad money grow as well as narrow, we will want different companies with different business models, or some different companies with some different business models, I should say. But there's still some great business out there we need to own now. And then some new ideas. So we're seeing an acceleration in working from home. Now, I don't think that is going back to where it was before. This could be one of those areas. If this was a trend anyway, I think, although we will overshoot and come back again, servers, cloud, software systems, these are underutilized in China. That's a secular growth area. So I mentioned them already. We're picking up more. We're picking up components in that work from home space in Taiwan. Very, very exciting names. Not only are they relatively immune in this crisis, but also will do well, I think, from here on as well. So I don't think the commuting economy will come back to quite the same degree in many Western countries as it was. So plenty to do, plenty of stocks that we're getting an opportunity to buy in, I think, and we're going to look back in a few years' time and think, wow, we bought that great franchise at that great price. And of course, I have a team of people that have done this a few times before in various crises. And I think this could be another one of those. It's the opportunity to get huge, 19 baggers and 10 baggers out of some of these big names that are big, large cap stocks as well. And that doesn't come along very often, let's face it. So we're actually getting very excited about it.
Okay, Ian, thank you very much. That's all we have time for today, and thanks so much for your insight and expertise. So,
thank you. Anytime.
Great. Thank you so much. So to our valued investors, just to round up then, so the unique country and liquidity analysis, along with the careful stock selection focused on companies that beat their cost of capital, has been a consistent value add for the investors in the fund. Now, we disseminated a short note on the fund last week. If you haven't received it yet, please do contact your relationship manager, who will be happy to forward that on to you. And otherwise, just please feel welcome to contact us with any additional questions or concerns that you may have. Your trust is important to us, so rest assured that we are available to support you and your clients during these difficult times. Otherwise, thanks very much for joining us today. Reminder that we'll be speaking to Tony Cousins on the Nedgroup Investments Global Cautious Fund tomorrow morning at 10. Best wishes for the rest of the day, and we look forward to connecting with you again soon.